Before we get started, please note that this video is for informational, educational, and entertainment purposes only. It does not constitute financial advice. We are not registered financial advisors. Always do your own research or consult a qualified professional before making any financial decisions.
Hey guys, welcome back to JP Firepath channel. This video is part of my JP Firepath series where we are building investing knowledge step by step from a complete beginner to a confident long-term investor without hype, without trading and without any stress. So far in this series, we have already covered how to think about investing, which Canadian account to use like TFSA, RRSP and FHSA, which platform to choose such as Simple or Questrade. If you're new here, I highly recommend watching those videos first. I have linked the playlist below so you can get a strong foundation before moving forward. Now today is the most important video in the entire series because in this video we are going to clearly break down what are the ETFs, the different type of ETFs and how those ETFs are actually used inside your portfolio. And most importantly, by the end of this video, you'll be able to confidently answer this question: which type of ETF, strategy, and portfolio actually suits you? Whether your goal is long-term growth, passive income, or stability and safety, or a balanced mix of everything. By the end of the video, you will know how ETFs fits together and how to start investing without feeling overwhelmed or confused. Alright, let's start from absolutely basics. Before we go any further, let's start with most basic question. What is exactly an ETF? ETF stand for Exchange Traded Fund, but don't worry about the name. The easiest way to understand an ETF is to think about it as a basket. Instead of one single stock, you're already buying a one basket that already hold many stock inside it. For example, one ETF hold 100 companies, another ETF hold biggest companies in the US, another might hold dividend paying Canadian companies. So when you buy one ETF, you are instantly getting exposure to many companies or many assets at the same time. That's the key idea. One purchase, built-in diversification. ETFs can hold stocks, bond, cash-like investment, or even things like gold, crypto, and so on. You don't need to choose an individual winners. You don't need to constantly monitor your investment. You simply invest in the basket. Now you understand what is an ETF. The next question is why ETF instead of picking individual stock? Now, here's the honest reality, guys. Most people don't lose money because they are lazy. They lose money because stock picking is stressful and emotional. When you invest in individual stock, one bad earnings report can hurt your entire portfolio. One headline can make you panic. And you're constantly asking, should I sell? ETF remove most of that pressure. Because with ETFs, you're not depending on one company. You're not trying to predict the next winner. You are investing in the overall market. Historically, market grows over the time. Even through the individual company come and go. So ETF can help you. Stay invested, stay consistent, and stay calm. And in investing, calm and consistency matter far more than being clever. Now, one important thing to understand is this: not all ETFs are the same. Different ETFs are designed for different goals. That's what we're going to break down today. Next. Before we start picking ETF, guys, the first step is to decide your purpose of investing. Ask yourself, do I want long-term growth, building wealth over decades? Or I'm looking for a regular cash flow like dividends? Is my priority capital preservation, playing the safe game? Or do I want exposure, high risk opportunities like innovation, bitcoins, or stuff like that? Now, here's the cool thing: you don't have to just pick one. Again, you can also take hybrid approach, mixing different goals, which is exactly what I do in my portfolio. Your goals might be also depend on your age or your life stage. In your 20s or 30s, you might want to focus on growth ETFs to maximize long-term growth. If you're closer to retirement or need income, you might need to focus on covered calls or dividend ETFs. Once you know your goal, it's much easier to choose the right ETF for your portfolio. So here are some of the main ETF strategies you should know. Growth ETFs designed for long-term wealth. Broader market exposure, core for growth. Second, the dividend ETFs generate regular cash flow, provide portfolio stability. Covered calls ETF use covered call strategies to earn income. Slightly more risk but higher payouts. Capital preservation ETF focus on protecting your capital, including cash, short-term bonds, or T-bills. Opportunity or satellite ETFs. High risk, high reward investment could include innovation or crypto ETFs. Understanding these ETF type first help you to align your portfolio with your goal, which will be start mapping in the next slide. Now that we understand ETF type and their purpose, now let's see how they fit into our portfolio buckets. This is basically how your investments are organized. Core equity US provide the main growth portion of your portfolio. For example, S&P 500, total US market. Growth equity technology. Focus on high growth sectors like technology. Examples, Nasdaq. Core equity Canada provide domestic equity and dividend exposure for stability. Examples, Canadian equity, Canadian dividend, or Canadian total market. Cash and stability. It protect your capital, keep your portfolio safe. Example, cash or T-bills. Satellite growth. Small portion of your portfolio for high risk, high reward opportunities. Example, innovation, crypto. Remember, these are the conceptual examples. In the next slide, I will show you a sample portfolio table with exact allocation so you can see how to put into action step by step. Alright, now let's put everything we learned into a practical example. A sample portfolio for growth investors. Remember guys, growth investor. Now, quick disclaimer, this is just an example, not a financial advice. Always do your own research before investing. The goal here is to help you understand how ETF strategies, portfolio buckets, and underwrite exposures fit together under one portfolio. For this growth portfolio, the main goal is long-term capital growth. So most of your portfolio, about 90%, goes into equities. So look into the table, especially highlighted in green on the table. Let's break it down. First one, the core equity, about 50% of your portfolio. For example, S&P 500 ETFs like VFB, ZSP, or total US market ETFs like VUN or XUU. So you can pick one, two, three depending on your research. Growth equity, technology. Around 25% of your portfolio focused on technology ETFs like Nasdaq or tech ETFs. Some of the tickers are HXQ or QQC. These are the higher growth option for long-term growth. The third one is core equity, Canada. About 15% of your portfolio in Canadian dividend ETF or the total Canadian market exposure. Examples, VDY, XDIV, XEI. These add domestic diversification while providing some income. Now we have cash and stability in the blue color here. 8% in the cash or T-bills like ZMMK or cash ETFs for liquidity and safety. Now finally, a small portion to the satellite growth in the red. 2% in the Bitcoin ETFs like BTCX.B or BTCCC for high risk, high reward opportunities. Now, here's what you have to do the next. Research your ETF. Pick one or two options based on your research. Decide your allocation. Remember, everyone allocation can be different. Some may prefer more US exposure, other more prefer Canada, or some more prefer more technology. You can be more defensive if that suits your goal. This is just a sample portfolio designed for growth-oriented investor. The allocation is flexible and should fit your personal preference and risk tolerance. Alright, we're done with that. Now let's look at sample portfolio for an income focused investor. Someone whose priority is generating consistent income, whether for retirement or building income streams early. Now again guys, quick disclaimer, this is just an example, not financial advice. Always do your own research before investing. This portfolio is perfect if you are tied to the 9 to 5 grid. and want to start building monthly passive income. The earlier you start, the sooner you can reach your passive income goals. And remember, even for the younger investor in their 30s or 40s, you can follow this approach if you want early financial freedom. FIRE, remember the channel of the name. Let's break it down again. So 50% goes to the S&P 500 covered call ETFs. Again, these are all guys mostly covered call ETFs. Okay, so do your own research. So some of the tickers are USCL, HYLD, ESPX, designed to provide regular income while still offering potential growth. The second one is growth, again technology, around 25% in the technology ETFs like Nasdaq, ZWT from BMO, one of my favorite, QQCL, QQQY, HHIS. Even in an income focused portfolio, a portion is allocated to the growth opportunities. Core equity Canada, about 50% in the Canadian dividend ETFs, or sector focus like banks and energy, HDIV or Bank Plus ENCL, provide steady income for domestic dividends. Cash and stability, again, similar to previously 8% in cash or T-bills for safety and liquidity. And this one also remains same 2% in the satellite growth like Bitcoin. The ETF ticker has changed, is BTCY or HBIX for high risk, high reward. Again, I kept the weightage same. It's just only the ETF ticker gets changed. The previous one was more growth. This is more income focused. Now here, what you need to do next again? Research, select your ETF, pick one or more from the examples shown or one of your favorites one. Decide your allocation. All right. Now you have seen growth versus income approaches. Now let me show you my own portfolio strategy, which combine both worlds, the growth and income approach, and how I personally allocate my investments. Alright, here's the big moment. This is my personal portfolio, where I combine best of both worlds, growth and income. Again, guys, quick disclaimer, this is not financial advice, this is my personal allocation shown as example. Do not copy paste, always do your own research and make decision based on your own research, on goals, risk tolerance, situation, stuff like that. And also, I'm also including links to the every ETFs in the description so you can check them directly on the provider website and do your own research. Now, just for your information, I'm in my 30s and my approach is very simple. I want growth, but I also want to start tracking my monthly income now. Eventually, when I reach my passive income goal, I can call it a day from my 9 to 5. That's why I do a hybrid approach like 50% growth, 50% income. Now, again, everything is mostly same in the table. Let's go very quickly one by one. First, the core equity. So this is I'm doing 40%, 45% of my portfolio. I am having growth and income both. VFB, USCL, HYLD provides long-term growth with some income potential from covered calls or dividend options. Second, the technology, I have the 30% weightage in this one. So the ETFs like QQQC, ZWT, QQCL, HHIS keep my portfolio future focused and capturing some high growth opportunities. In terms of Canada, my portfolio is 15%. So I have ETFs like VDY, which is the dividend king, HDIV, Bank and ENCL to provide steady domestic income. Cash and stability, 9% in cash, ensure safety and liquidity, a buffer for volatility. Satellite growth, 1% in Bitcoin, BTCY, HBIX adds high risk, high reward exposure to my portfolio. Now, some of the actionable steps for you guys. Review these ETFs, pick the one fit your goal, decide your allocation. Everyone allocation will be different on their risk appetite, goals, age. Remember, this is my hybrid strategy. Depending upon your goal, your portfolio might lean more on growth or income. The key is to start now. Track, adjust your goals as you evolve into the investments. Alright guys, now you have seen the three portfolios, growth, income and my personal portfolio as well. Now let me move into this final slide where we're gonna be covering some of the key takeaways and what will be the future videos will looks like. Alright, that's the wrap up everything we learned in the JP Fire Path series. First, remember most important principle, consistency wins. You don't have to pick perfect timing. Using the dollar cost averaging, consistency will grow your wealth over the long term. Second, time in the market beats timing the market. Staying invested is more important than trying to chase the short term gains. Third, follow the step by step approach. Define your goals, choose the right Canadian account, pick a brokerage, select the right ETF for your portfolio. If you need to go back, review the previous videos, they'll help you to make more sense of each step. Finally, this is the officially the last video of this series. But don't worry guys, I'm still here. I'm not disappearing. We'll be creating more independent videos. There are so many topics to cover, but obviously I don't want to continue this series. I think this is the just again series for the beginners. Now you have passed the beginner step. Now we're gonna be going into some independent deep dive videos. So like we're gonna be comparing some ETF performance on different categories. Exercise, we're gonna be doing some exercise how to reach your financial goals. Tips and tricks like ETF tracker or better investing tricks. So stay tuned and remember the goal is long-term stress-free growth, not chasing the quick wins. Let's make investing simple, consistent, and effective. Alright guys, that's it for this series. I'll see you in the next video. Till the time, take care and bye now.